Alright, Chapter 2, Section 3, page 38 in the book. Analyzing how transactions affect the owner's equity accounts. Okay, on August the 12th, you received cash from sales. Cash is going to increase. Sales is revenue. Sales will ultimately increase the owner's equity account. Okay, again, you can ask these same questions. Which accounts are affected? Cash and sales. How is each account classified? Cash is asset, sales is a revenue account. How is each classification changed? Assets increase, owner's equity increases. How are you going to enter that into the accounts? Assets increase on the debit side, owner's equity will increase on the credit side. Okay, we have sold services on account, we have paid cash for an expense, and receiving cash on account and paid cash to owner for personal use. Okay, so we're going to go through each of these. You still have the same 4 questions, but this section is basically dealing with how it affects the owner's equity account. So let's go ahead and do the work together 2-3. April the 10th, you received cash from sales. Okay, received cash. Cash is an, let's see, answer these questions. What 2 accounts are affected? Cash and owner's equity. So our cash is going to increase as a debit, and in this case it's $600. And sales ultimately increases our owner's equity account. Sales is a revenue account. Sales has a balance side. The balance side is the credit side. It's our normal balance side, and it shows increases on the credit side. Okay. April the 11th, sold services on account to Sam Erickson. Which 2 accounts are affected? Sold services is sales. On account is our customer. He did not pay us now, he pays us later. That is in accounts receivable. Services, sold services is sales, which is a revenue account, and accounts receivable is an asset account. Our accounts receivable increased, but so did our sales, so we're going to increase on either side of the accounting equation. And remember, our debits go first, so instead of getting cash, we set up an accounts receivable. Both are asset accounts. Assets increase on the debit side, $850. Okay, sold services, sales. Sales, your normal balance side is the credit side, which shows increases, $850. On the 14th, paid cash for rent. Cash is our asset account. Cash goes down, decreases. Rent is considered an expense. And expenses ultimately reduce the owner's equity account. So rent expense is kind of like our exception to the rule. It's going to go on the, let's see if I can find the page. Page 40. It still goes on the right side of the accounting equation, but it's our exception. Okay, it may go on the right side, but our normal balance side is going to be on the debit. Okay, our expenses went up $250. We paid cash, so our cash decreased, and that's shown with a credit. On April the 18th, received cash on account from Sam Erickson. He's our customer. He has paid us. So our cash increases. He paid us $425. Our accounts receivable decreased. So we're going to show a decrease to an asset account with a credit. And the last one on the 20th, paid cash to owner for personal use. Basically, the owner is taking money out of the business to use personally. So our cash is decreased, and so is ultimately our owner's equity. Okay, and we show owner's equity in what's called the drawing account. Kathy Bergman, drawing. Withdrawals decrease owner's equity. We're going to summarize these in its own separate account. It's still an owner's equity account, but we want to keep up with everything withdrawn. So she withdrew $300. It reduces our cash $300. Drawing is set up specifically to reduce the capital account.